Hello, I'm Kevin Baldwin with eXp Realty. I'm here to break down why mortgage rates may be climbing even as the Bank of Canada tries to lower them. Let's get into the details because understanding this could help you make better financial choices. Initially, it's essential to understand that lenders have experienced increased funding costs, a trend driven mainly by prevailing economic uncertainty. Banks pay a premium to secure the capital they need to operate effectively as the financial landscape becomes more unpredictable. This heightened cost of borrowing does not simply evaporate, instead, it frequently gets transferred to the consumer through higher interest rates. Consequently, even when the Bank of Canada implements a reduction in benchmark interest rates, the impact on mortgage rate is somewhat limited. The increasing funding costs counterbalance these reductions, resulting in persistently elevating mortgage rates that affect potential homebuyers and those who are looking for refinancing. This dramatic highlights the intricate relationship between banking costs and consumer borrowing, illustrating how the broader economic factors can directly influence the financial decision of everyday individuals. Now let's talk about the bond yields. Fixed mortgage rates follow government bond yields more closely than the bank's policy rate. So if bond yields remains high due to inflation or economic uncertainty, regardless of what the Bank of Canada does. Lenders are taking a proactive approach to manage this risk in uncertain economic times. When the financial landscape appears unstable or unpredictable, these institutions tend to implement a slight increase in interest rates as a precaution measure to shield themselves against possibility of borrowers defaulting. This additional cost, often called as risk premium, can inadvertently rise the mortgage rates despite the central bank's attempts to lower them. Consequently, potential homebuyers may face higher borrowing costs, highlighting the complex interplay between lending, risk management, and broader economic policies. Another factor is that markets often predict cut rates and adjust accordingly. By the time the Bank of Canada officially announces a cut rate, the bond market have already priced it in. So further cuts might not always lead to an immediate rate drops or for the borrowers. There's often a delay in rate adjustments with the Bank of Canada's announcements. Lenders wait, analyze, adjust based on broader conditions, so mortgage rates might not change immediately. After the rate cut, more people tend to apply for mortgages. This demand can increase mortgage rates as lenders maintain elevated rates to balance the influx of new applications. Lastly, lenders want to keep their profit margins stable to uncertain times. Even as the Bank of Canada cuts rates, lenders may keep mortgage rates high to secure the bottom line, ensuring they're ready to make for the market shifts. When interest rates increase, it directly impacts the purchasing power of potential home buyers. Specifically, for every 1% increase in mortgage rates, a buyer's capacity to afford diminishes significantly. To put it into perspective, a 1% rise in rates could decrease purchasing power by approximately $45,000 if we consider a home at $400,000. This substantial reduction in affordability can compel buyers to reevaluate their options, often pushing them toward lower-priced properties that might not meet their original aspirations. Alternatively, it may drive them to save more diligently for a larger down payment as they seek to regain some of the lost purchasing power in the increasing challenging market. Let's not forget those monthly payments. The higher rates mean higher payments, which can stretch budgets thin and make home ownership harder for many Canadians. A recent survey revealed that approximately 74% of Canadians are postponing their purchasing decision. They anticipate a decline in the policy rates below the 3% threshold. This prevalent wait and see strategy among potential buyers could significantly affect the market demand and housing prices. Suppose a substantial number of prospect buyers continue to remain on the sidelines. In that case, we may witness a notable slowdown in the housing market, dramatics ultimately influencing property values. The collective hesitation of these consumers could contribute to a shift in the balance between supply and demand, which would affect the overall real estate landscape shortly. With mortgage rates rising, buyers might look at adjustable rates. That starts with lower initial rates. Others may prefer fixed rate mortgages to lock in a rate that guard against future hikes. For some, rising rates created urgency. They don't want to wait for the rate to increase, so they rush to buy before the rate climbs. This decision can sometimes lead to nasty purchases in competitive market. Your credit score has never been more crucial. With higher rates, good credit is essential to getting the best possible terms on a mortgage, making it important to maintain strong financial habits. In the light of recent increases in mortgage rates, many individuals are reevaluating their home ownership aspirations. Potentially, buyers may contemplate alternatives aligned with their financial realities as their rates rise. This could lead them to explore purchasing more affordable homes, which might involve adjusting their expectations regarding property size, location, or features. Additionally, some may consider extending the length of their mortgage terms to ensure that monthly payments remain manageable, easing the financial burden that comes with higher interest costs. This strategic approach not only helps in making housing more accessible, but also reflects a thoughtful response to shifting dynamics of the real estate market. Higher mortgage rates mean cuts in other spending for those who already own homes. This can have a broader impact, with families budgeting carefully and possibly spending less on non-essentials. The recent rate cuts the Bank of Canada implemented do not automatically translate to lower mortgage rates for homeowners and potential buyers. Various essential factors come into play when determining mortgage rates, including lenders' funding costs, fluctuation in bond yields, and impact of all overall interest rates, the perceived risk associated with lending, and prevailing market demands for mortgages. For Canadians looking to secure a mortgage or refinance an existing loan, grasping at the intricacies of these dynamics is crucial to successful navigating and complexities of the current high rate environment. Thanks for tuning in. If you found this helpful, please like the video, comment, and subscribe for more insights in the Canadian real estate market. And if you're looking to buy or sell, reach out. I'm here to help me make the process a little easy. See you in the next video.